In every modern economy, hidden behind the headlines, political speeches, and market noise, there exists a force so powerful and so quietly influential that it can rewrite the rules of wealth without the public ever realizing it happened, and that force is the world's central bank's institutions, presented as guardians of stability, yet operating with a level of secrecy and autonomy that allows them to shape prosperity, poverty, and entire economic cycles with a single policy decision, raising a mystery few ever question. If central banks are merely managers of money, why does every major financial shift in history begin with their actions? To understand how this silent power took shape, we need to go back more than a century. The money was still tied to something solid, something universal gold, and when economic discipline forced governments to live within their means. Because before central banks gained their modern form, wealth wasn't easily manipulated. It grew slowly, predictably, and painfully, controlled by the limits of mining, trade, and physical resources. But as industrial empires expanded and wars demanded unlimited funding, political leaders turned to economists and bankers for a new idea, one that would allow nations to grow faster than their resources, spend more than they earned, and project power far beyond their borders. That idea was the creation of centralized monetary authorities like the Federal Reserve in 1913, the Bank of England's evolving mandate, and later the European Central Bank. Each one designed to stabilize their economies, yet slowly acquiring the ability to influence interest rates, credit flows, and eventually the global financial order itself. The origins were modest. Central banks were supposed to manage currency supply, prevent bank runs, and act as lenders of last resort. But the rise began when they discovered an extraordinary tool, the power to control interest rates, effectively deciding how expensive or cheap money should be, and therefore shaping everything from home prices to stock valuations to national debt levels. Because once a small group of unelected officials could make borrowing cheaper, they could stimulate growth on command, and when they raised rates, they could slow entire economies overnight. Then came the turning point that shifted the system permanently in 1971. When President Nixon disconnected the US dollar from gold, central banks were no longer constrained by metal reserves. They now operated on pure trust, global confidence, and political necessity, allowing them to create money with keystrokes and influence economic outcomes through expectations alone. At which point, wealth itself stopped being tied to productivity and began orbiting around monetary policy, asset inflation, and credit expansion. The rise intensified during the 1980s and 1990s. When globalization accelerated and financial markets exploded in size, stock markets soared as central banks increasingly intervened during downturns, creating what investors started calling the central bank put. The belief that no matter how dangerous the markets became, central banks would always rescue the system with lower interest rates and fresh liquidity, a belief that encouraged risk-taking on a scale the world had never seen. But every system built on artificial stability eventually reaches a breaking point. That moment came in 2008, when the housing bubble fueled by years of cheap credit collapsed under its own weight, triggering the worst financial crisis since the Great Depression. And instead of allowing the system to reset naturally, central banks around the world stepped in with unprecedented force, slashing interest rates to near zero, injecting trillions of dollars into financial markets, and buying assets directly, actions once considered unthinkable that suddenly became normal, setting a powerful precedent. Whenever the system trembled, central banks would rewrite the rules again to prop it up. The fallout was enormous. While their interventions prevented total collapse, they also transformed the structure of global wealth, inflating asset prices far beyond the reach of ordinary workers, widening inequality as those who owned stocks, real estate and businesses benefited, while those relying on wages saw their purchasing power erode. Middle-class families watched home prices skyrocket, elites watched their portfolios multiply. Younger generations found themselves priced out of the economy their parents took for granted. Attempts to fix these imbalances repeatedly failed. Austerity policies choked economic recovery. Stimulus measures created temporary boosts without structural change, and regulatory reforms added complexity without addressing the core issue that the system now relied completely on central banks to maintain stability, meaning the normal rules of wealth creation no longer applied. The result was a global economy conditioned to expect intervention. It's addicted to cheap money and vulnerable to every rate shift, every policy hint, every quiet meeting behind closed doors, where central bank officials signaled their next move. And as inflation surged in the early 2020s, central banks faced their next crisis, forced to raise interest rates at the fastest pace in modern history, sending shockwaves through housing markets, stock markets, and global debt networks, exposing once again how dependent the world had become on decisions made by a handful of powerful institutions. Today, the pattern is unmistakable. Whenever the economy overheats, central banks cool it. Whenever it slows, they stimulate it. Whenever debt grows unsustainable, they adjust rates to make it manageable. And whenever markets panic, they intervene, quietly rewriting the rules of wealth with each cycle. The data is staggering. Global debt has surpassed $300 trillion. Central banks collectively hold trillions in government bonds, real wage growth lags behind asset inflation. And the top 1% owns more wealth than at any point in recorded history, patterns that repeat across continents, economies, and decades, all tracing back to the same hidden mechanism: the immense power central banks wield over money creation, credit flow, and the value of every currency on Earth. The modern parallels are even sharper. Digital currencies being explored by central banks promise efficiency, but grant unprecedented control. Interest rate decisions can make or break entire industries overnight. And geopolitical tensions amplify the influence of monetary authorities, who now operate not just as economic managers, but as quiet stewards of global stability, deciding, often without public input, how wealth is distributed, protected, or sacrificed in the pursuit of macroeconomic balance. 3 takeaways emerge from this century-long story. First, central banks hold far more influence over wealth than most people realize, shaping markets and economic opportunities through decisions few understand. Second, the evolution of money from gold-backed to policy-driven has created a system where expectations matter more than resources, and confidence is the real currency. And third, every intervention sets the stage for the next crisis. Because when the rules can be rewritten at any moment, long-term stability becomes an illusion. As we move toward a future of digital currencies, rising debt, and tighter global integration, the question isn't whether central banks will rewrite the rules again, it's how, when, and at what cost. If you want to understand the hidden forces guiding the financial world and shaping your wealth without you noticing, subscribe and stay with this series as we uncover the next layer of the economic architecture that most people never see.